Hey, family. This is Che Willis coming back with another episode of Wealth is a Journey podcast. Guys, this is episode 107, 107 weeks of consistency, 107 weeks of getting it done, giving you guys good information to hopefully help you on your wealth building journey. If you are a first time listener, watcher, or subscriber, thank you so much for joining us. On this podcast, we talk about faith, family, and finances, among other things. If you are a return listener, watcher, or subscriber, thank you so much for joining us again. Hopefully, we are adding value to your lives on the way to the M's. Because yes, we are on the way to the M's. So, guys, today this is going to be a very very good conversation. I cannot wait. I was super excited. We have a special guest to talk to us today about taxes. Taxes. I cannot wait. Today, our special guest is Dean Vance. Let's go. Dean, thank you so much for joining the podcast. We definitely appreciate you, and I'm sure you're going to bring a wealth of knowledge to the episode. So if you wouldn't mind just giving a small snapshot of who you are and what you do, and then we'll get rolling.
Yes, Shay. Yeah, thanks for having me on. My name is Dean Vance, as you just said, and I'm a father. I've got two boys and a daughter. Two boys. My oldest son works at the office with me, and my other son is a sales guy, and my daughter is homeschooled. And other than that, I'm a businessman, right? I'm a CPA here, owning Vance and Associates CPA here in Bluebell, Pennsylvania, right outside of Philadelphia.
Hmm.
And we specialize taxes, accounting, and specifically on small business tax and accounting. We do have individual clients, but our focus is on small business and helping them kind of navigate their taxes, navigate their profit making, and for some navigating their exit out of there. So that's my
That's
background.
awesome, man.
Yeah, yeah. Thanks.
Yeah, thank you again for being on here, man. You're in Bluebell. Did you grow up in mainline area?
Grew up, no, no, no. I grew up I grew up overseas when I was younger,
Mm-hmm.
but came back here in 1968. Well, born in Philly, went overseas for about 6 years, came back here and lived in Mount Airy, Germantown section of Philadelphia. We moved out here, 2007, out in the Bluebell area. We
Hmm.
lived there for about 10 years, and we moved back to Philly, but I kept the office here. So yeah,
Wait. You moved from Bluebell to back to what
yeah,
part of Philly did you move to?
Mount Airy.
Okay. Oh, okay. All right.
Okay.
Okay.
Are you from
I,
Philly?
well, I'm from Ardmore, Pennsylvania.
Oh yeah,
You know
yeah.
Ardmore, yeah.
Yeah,
So I'm
my
from
cut.
Ardmore. I went to Lower
Yeah.
Merion, and
Okay.
my mom and dad moved to Philadelphia, to
Okay.
West Philadelphia, to
Uh,
what is it? Overbrook area.
okay.
They
Okay.
moved to
Will Smith.
Overbrook,
Will
and
Smith.
then back to
Okay.
Ardmore. Once I think I graduated college, and they moved back to
hmm
Ardmore.
hmm
Yeah,
You're like, what are you doing moving back to Philly? What do you,
that's what I'm saying. Like, what are we doing? But Mount Airy's a you
Matt,
get a
yeah,
lot
it's
of house for
decent.
your money.
Yeah, yeah, you do. You do.
Yeah,
Yeah,
yeah.
yeah, yeah, yeah. So we had been out here, God, for about 10 years, uh, for the school district out here. There's a place called Wissahickon School District.
Hmm.
Great school district. We came out here for that. So I had three of my boys go through the district, my stepson and my two other sons going through the district. Excellent education.
Yeah.
And then we moved back to Philly after they were done. Yeah,
Cool.
yeah.
So, Dean, I always like to get into the backstory of
hmm
who my guests are, and as far as their financial background, right? And it's always fascinating to me to find out about like where and when did you learn about money growing up? Did you do like trial and error? Because
Ooh, yeah.
a lot of people I talk to, they never learned about money until they became an adult, and
hmm
then they're like, "What do I do? How do I set up a budget? How do I manage
Right,
my money?" And it just
right.
like it goes kind of downhill sometimes. So, how did you learn?
Yeah, a kind of school of hard knocks, you know.
Yeah.
I will say that both my parents are pretty good with their money. My mother would always tell me, one day you'll respect money. Yeah.
Hmm.
I can't say she actually sat me down and went through a process of doing money. I
Yeah.
remember when I was about 8 or 9, we had my brother and I had a race. He's like 19 months older than me. We had a race to find out who would get to $100 first, who would save $100. And he easily he easily beat me.
Yeah.
He got to 100. I probably had 20 saved. Who knows? But But for the most part, Shay, the School of Hard Knocks reality
Yeah.
is a serious teacher, right?
Yeah.
And I took money for granted to a certain extent, but I've been in enough pinches in the School of Hard Knocks to learn not to play with the finances. And you got to take care of the finances. My father told me one time, he says, "Look,"
Yeah.
he said, if you don't take care of certain things, reality is going to just grab you off the street and slam you against the wall. So
Yeah.
I had some of those that kind of got my attention. I found I did accounting at St. Joe's. I went to St. Joe's University
Okay.
out in the main line and
Yeah.
or City Avenue. It's not really the main line, but we
Depending on
were
what side of the street you're on.
that exactly that's true. That's true. As a matter of fact, my dorm was on the main line, so that's thank you for that, by the way.
Yeah.
But yeah, so at St. Joe's, I was pre-dental, right?
Mm.
And I was pre-dental. My father had gone to medical school, never completed medical school. Um, so I thought I need to make up something. I thought I need to have a Dr. Vance in the house, right? So I did that.
Yep.
But I couldn't be more incompatible with dentistry or any kind of doctor thing than anybody because, every time I would walk by the science building, my blood pressure would go up, right?
Mm.
Um, and I said, you know what? I remember I went to the head of the head of biology department. He says, look, you can try accounting. Accounting is quantitative. It's not like this. I took accounting and I got an A. And the thing
Mm.
about accounting was that it was so logical. It wasn't opinion. Debits equal credits. Very Vulcan. Very Spock-like logic. Okay,
Yeah.
and there was a certain kind of freedom and security for accounting. And I remember my uncle told me, he said, look, because I didn't know what I wanted to do. I was thinking about maybe management marketing. I actually technically, after the pre-dental, it was management marketing as a degree. But I took that accounting course, got an A in it. I liked it. I switched to accounting, right? My
Mm.
uncle had told me, he said, look, he said, if you don't know what you want to do, go into accounting. Look at the help wanted pages, right? It's
Hmm.
just it's just accounting, accounting. And this is like back in the early 80s. So this is like a Reagan era,
Yep.
money, things were moving conservative, finance, stock market, things like that were popping up at the time. So
Yeah.
that's my quick background.
Wow.
Yeah.
Man. So, because I have a similar story where I went to college to be a computer science major.
Hmm.
And the only reason I was going to be a computer science major was because my buddy in high school, he went to go be a computer science major. I had no desire at all to go to college whatsoever, but I went
Hmm.
because everybody
Hmm.
else was going. So I'm glad I did.
Hmm.
But I ran into somebody at school and during freshman orientation, he was like, "Yo, do you know what you want to do after college?" I'm like, "No." You're just lucky I'm here. You know what I mean?
That's right, 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 right.
And then as we got to talking, he was like, "Well, why don't you be a marketing major?" He's like, "You like to sell stuff?" I'm like, "Yeah, I like
Hmm.
to sell
Hmm.
stuff." And that conversation, as you're talking, now that I'm thinking about it, changed my life. Because if I hadn't of, then I would have went in the field I had no desire to be
Yeah,
in,
yeah,
and
yeah.
I might have been, because a lot of people like in college,
You might have been an accountant.
no, the thing is, no, the thing is, like a lot of people, they'll go to school for things, and they don't end up in the field that they
Yeah,
went to school for.
yeah, yeah,
So I'm glad that I did that because I know like with the computers and all that stuff,
yeah.
like that has no interest to me at all. Like,
It's fascinating, Che. One of the things that I recognize as I went through in my business is that you can go to school for certain things, but you can't go to school to change your temperament.
mm,
You got a particular temperament, right?
yeah,
For the most part.
yeah,
And I won't say I won't say the temperament is static. It's got a certain elasticity because we're not animals, we're humans, right? So
sure,
we can change things. We're not all instinct. We're partly instinct, but partly, obviously we can create. One of the things that I did, it's probably part and parcel why my son is here, right? My oldest son, who also went to St. Joe's, right?
hmm
30 years old. He went to school out in, well, anyway, that's digressing there. But there's an assessment called the DISC assessments,
yep,
DIS. You've heard of it? Yeah.
hmm
Yeah, we took the DISC assessment. I have a temperament for entrepreneurship, leadership. I'm a high DI, so dominant, influential, right? So
hmm
part of me is extroverted, task facing. The other part of me is extroverted, people facing, right? Now,
Hmm.
my son is a high, so-called high DC. So he's a high dominant conscientious. And that combination is more temperamentally harmonizing for the work that we do than mine is. So when he
Hmm.
came in, I was surprised that he came in. I said, "Look," because he was running away from something else he hated doing. He was in a real estate management company for 2 years, and
Okay.
he would call me up. I would kind of talk him off the ledge, just hang in there, son. Don't worry about it. But after 2 years, he came and worked for me. I said, "Look,
Hmm.
work part time, see how you like it." And tax season work full time. And then after a year, he actually liked it. And so for me,
Hmm.
it underscored the assessment. Like what the assessment said would happen actually did happen, right? So it kind of undergirded my belief in the disc assessment. So in turn, I hired two people under him, right?
Hmm.
So let me just kind of backtrack here. So on the disc assessment, I'm a high DI, he's a high DC. On a combined assessment for both of us, it said hire somebody who's a high CS or high SC. So we've hired two accountants. One's a CPA, others is a bookkeeper. They have high CS, high SC, and the personality and everything else plays out exactly the way the assessment said that it would play. So we're very harmonized in the office.
Yeah,
It's a pretty good, yeah, pretty good thing.
man, that's awesome. So now you graduate, you get into do you get into entrepreneurship immediately, or is
No,
that
no,
something that
yeah,
but
no, yeah. So I graduated in 1983,
hmm
and for a year, I'm just trying to think. I think I might have taught for a year at community college. But 83, 84, 85. Yeah, 85. No, 84. I went to Drexel grad school. Right. So I
okay.
started Drexel grad school, went there for a master's in taxation. Right. Now, the master's in taxation had you sitting for hours doing tax research. And given my disc assessment, I'm not like,
Yeah,
I mean,
it's not working for
that
you.
wasn't going to work for me, right? Much better doing presentations, much better doing sales, kind of that development, kind of being out with people, that kind of thing.
Hmm.
But from there, I worked at a place called Schatz Miller and Glessman.
What's going on, family? This is Che Willis from Wealth is a Journey. Did you know that we just started a wealth building community? In this community, we meet once a month on Zoom. We discuss financial areas of opportunity. We discuss wins and strategies to get you to the M's. In anybody's wealth building journey, if you're just starting out, it can be super lonely and difficult. In this community, we're also going to hold you accountable to where you say you want to be. So if you need the accountability, if you need the family atmosphere, if you need help getting to your desired financial result, come join the community. My website is www.wealthisajourney.com. Join the community today to get to your financial result. Thank you.
And by the way, I went to Drexel because they had a co-op. They were known for
Okay.
their co-op. So this
Yep.
was a graduate co-op. So I went to Schatz Miller and Glessman for 3 months during tax season. And then from there, I went to a place called Tasty Baking Company.
Hmm.
Well, you heard it. Yeah, they
Oh
make
yeah, taste the cake. Yeah.
tasty, exactly,
Yeah.
tasty cakes. So I was at Tasty Cake for 4 years. And I remember being at Tasty Cake. Great place, by the way. I
Hmm.
worked under Chris Merger. She had worked at Price Waterhouse, and so she was very technically savvy, the whole nine. So while I was there, I sat for the CPA exam. I passed one part at a time. Right, this is back when you could do that. I think you could do that now. I'm not really sure, but I passed one part at a time
Hmm.
and got my CPA. But I had to get experience, so I was there 4 years. And I remember being by the way, I remember being at Tasty Cake and you hear people talking about, oh, corporate America, I got to get out of here. So anyway, long story short, Che, I left there, come back a year later, and the same people are still there. Yeah, I got to get out of here. Meanwhile, I've
Same
already
story.
left. Right, I've already left. I started my own practice, just basically doing tax returns. Right, so back then I was just doing tax returns, 1040s, Schedule Cs, things like that. Right.
Hmm.
Um, and and that was like I want to say that was about 19. You weren't even born back then, by the way. This is like 1991, 92, something like that,
Oh
roughly.
man, I was born in the 80s. I was
Oh, really?
79
Okay.
actually.
Oh,
I'm
okay.
79.
Oh, get out. Okay.
Yeah.
as my mother would say, you're well preserved, right? So
Appreciate that.
yeah, no problem. So so you were Kobe era kind of guy.
Yeah, I went to school
Okay.
with him. Yeah, I went
Okay,
to school with
cool.
him. Yep.
Nice, very nice, very
Yeah.
nice. God rest his soul.
Yeah.
But yeah, so it was anyway, so I think I answered your question, Marilyn. I'm kind of jumping all over the place here. But yeah.
Yeah. So okay. So one of the things that well, I'm glad you're here is
Mhm.
because a lot of people, what that I grew up with anyway, when tax time came around, we were so excited to get a tax return.
Right.
But then as I gained a little bit more insight and knowledge, tax returns are horrible because it's basically free money that you're giving to the government all year, and they just give you money. They give you the money back that they borrowed
That's true.
basically
Yeah.
without getting a any interest on that. Can you elaborate on that a little bit on why it's a bad
Yeah.
idea?
Well, yeah, it's because it's your money. Good point. It's your money. I mean, certainly with our business clients, we meet every month, whether you're, introductory tier, which is one meeting, or controller tier, two meetings, or CFO tier, which is about 4 to 5 meetings a month. We're tracking your dollars the whole time. So we know what's taxable, what's not taxable. So by the
Hmm.
time April 15th comes, you're not, you're going to break even for the most part, right?
Yeah.
But to your point, um, you have the government who's using your money and paying you back hardly any interest on that money. They'll pay you some interest. But
Yeah.
what's interesting with the IRS is that the interest that they pay you is higher. How can I put this? No, the interest that they pay you is lower than the interest that you have to pay them if you're late,
Mm,
right? So
yeah.
they've got that little margin ahead of you. So it's bad because you're allowing them to use your money when
Hmm.
you could really actively be using this money, especially if you're a business owner.
Yeah.
Yeah.
Man. And then also there's a thing if you're because a lot of people like to have losses
Yeah, yeah,
all
yeah, yeah.
for multiple years in a row. And when I first got into business, we're my wife and I were in the real estate game, and we have properties, and we're always looking to have a loss, but at the same time, that's not good for multiple years in a row. Is that correct?
Yeah, it depends. I mean, you can have if you yeah, there's a hobby loss rule for sole proprietorships
Hmm.
that if you have more than 3 out of 5 years losses, the onus is on you to prove that you actually have a business instead of having a bona fide business, right? Or having a hobby, right?
Okay.
Like a hobby loss rule. But if you're going to take a loss, it's not just not good tax wise, it's just not good economically, right? Because you want to, obviously you want to make money, you want to gain and so forth, right?
Hmm.
But you can be with real estate, it's a totally different game. With real estate, if you're a real estate professional or if you're a passive real estate investor, there are two different rules, right? So a passive real estate investor, you can take $25,000 of loss per year, right? But as you get over 100,000, from 100 to 150,000, you lose that, right? Over
Mm.
150, you can't take any real estate losses. They get trapped. They get held in a, I want to say 89, 85. They get held in a form, and you don't lose it. It just gets, it moves year to year to year to year until such time where you can either take the loss or you sell the underlying asset, usually an apartment building or single family home, something like that. And then at
Mm.
that point, you adjust your capital amount of, loss that you couldn't take.
Oh, and is that the same thing as the hobby law?
No, no, two different
Totally
things.
different.
Two
Okay.
different things. Yeah, because the hobby loss thing is for sole proprietorships that are in active businesses, right? For the
Hmm.
most part, like for your properties, you're probably a Schedule E, I guess.
I think don't quote me on that. I don't,
No, okay.
yeah, I don't.
Yeah, okay. Yeah,
Yeah.
yeah. So if it's not in an entity, right?
Yeah.
So it could be in an entity, but if it's not an entity, you're going to be on Schedule E.
Mm.
Now, if you're a real estate professional, real estate professional doing over 750 hours a year on real
Mhm.
estate, then you're active, right? So you'll be on a schedule. I think you'll be on Schedule C
I
as a real
think we
estate
are on a
professional.
schedule C now. Yeah, because
Okay.
that sounds more familiar. Yeah.
Do you clock 750 hours a year?
No.
No. Okay.
No.
Well, all right.
Yeah.
Yeah, but I mean, to be on a Schedule C with real, so your underlying activity is rental real estate, correct?
Yeah.
Yeah, usually that's on Schedule E. That would usually be
Okay.
on a Schedule E, unless you're a real estate professional.
Got it.
Yeah.
Okay. All right. Well, hey, listen, man, I'm getting some education here. This is good for me. So selfishly, I'm glad you're here.
Good, good, good. Good to be here.
Yeah. Um, and then what about dinners, trips,
Hmm.
things of that nature? Like when is
Hmm.
that? When is the dinners like okay, that's enough. Like you're doing a little too much. Like when would that come into play?
Yeah, I mean, look, if you have a bona fide dinner I mean, we got people that got, dinners all over the place, meals, deductions, sort of all over the place. But if you've got bona fide, if the nature of what you do is
Hmm.
that you're meeting with clients or you're meeting with your employees or whatever, and you're clocking all these dinners, that's fine. That's an expense that's called a reasonable expense.
Hmm.
And it has to be reasonable to you, the taxpayer, right? If it's reasonable to you that your clock, like if you go to, I don't know, we go to a place called the American Star Diner on 63 in Lansdale, right?
Okay.
So my wife and I go there. That's not business. I'm not going to deduct that, right?
Yeah.
But if I go with somebody like a client of mine, or even with with Carrie who works there, and we're talking business, I'll deduct that. I'll put that as a
Yeah.
deductible meal. Absolutely.
Sure. Or if you and your wife go talk about business,
Yeah, yeah,
or business strategy meetings and things of that nature, you
yeah.
can write that off as well.
I could, except I didn't tell you my wife quit a couple years ago, right? So
Oh.
yeah, and Che was it was April 14th she quit. She quit. I said, honey, you can't quit. It's April 14th.
Yeah.
She said people quit all the time, right? So
Not.
she's technically doesn't work for us anymore, but she helps me out.
Oh man.
Yeah.
Okay. What is the biggest eye opener for one of your clients that you were able to save them money that they didn't know
Oh wow.
that they
Yeah.
would like? Can you give me an
Yeah.
instance or two?
God, I'll give you a couple. Yeah. So, oh man, yeah, I remember this guy came in when God, I was here on COVID. It was like 2020 was like May or something. This guy sends me a little thing, and I'm thinking this is like, because I get a bunch of you get emails all the time. And anyway, I meet this guy, and he gives me his tax returns. I go through his tax returns, and whoever did his taxes beforehand had totally, didn't hardly take any expenses. He just really didn't dig in like we tend to dig in, right?
Mm.
So I amended his tax return, got him back about maybe close to 300,000 between taxes and interest. Yeah,
Wait, 300,000?
300,000.
All right, tell me
Correct.
more about that, man. Like,
Yeah.
what did you do?
Well, first of all, he was a high net worth client, right? So
Got it.
he was at the 37% tax bracket. And by the way, Che, 37% is the highest tax bracket on the federal side, right?
Hmm.
So you got 37% federal. You got, in Pennsylvania, 3%, right? I think you might have had a local. So 37 and 3, 40, 41 local. The Medicare thing, it's called 42.
Hmm.
Oh, excuse me. That's actually Carrie calling. You turn that off. Um, I'm sorry. Turn this.
You're
Okay,
good.
cool. Yeah, yeah. And so every $1,000 that I could find of income that shouldn't be taxed or of expense that wasn't put on the tax return, right? Every $1,000 is multiplied by that 42%.
Mm.
So for every $1,000 that I could find, that's 420 bucks.
Yeah.
Okay.
Wow.
So it's
Okay.
almost half. So roughly about, um, I'll say about 225 for him, plus the interest went up to close to $300, $300,000, or certainly over 250 for him. But he was missing all kinds of things. So he had a home office and he had an outside office, and I told him, I said, for all these years, you could have taken your driving from your home office to your outside office. You can do that, right? Oh, really? Yeah, you can,
Mm.
right? So we did that. We did, there were some accounts that he had not figured into the calculation for, I'm sorry, let me turn this off. Yeah. Anyway, he hadn't,
I,
yeah, he hadn't figured those things. Yeah, we can,
mhm.
yeah. He hadn't figured out those particular deductions, right?
Yeah.
And he also one was that he and his wife had filed married filing separately. right? I'm like, why did you file marrying filing? That's like the worst. That's the worst tax rate, right?
Yeah.
So I think there were a couple of back-to-back years. So that Che coupled with his high marginal tax rate, right?
Mhm.
So that's one. Another one came in couple
Can
about
I
a,
can
yeah,
I
go ahead.
ask you a question real quick?
Yeah, yeah, sure.
Why is it married filed separately a bad idea? Why is that?
Well, because it's the highest tax rate.
Okay.
Why is it the highest tax rate? Because they're like, psh, 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 don't do that, right? Like if you look at the tax laws, right? A lot of the tax laws, I mean, they go through the Ways and Means Committee in Congress and all that. They hash out a particular tax bill, and then all the politics comes in, right? All the
Hmm.
social engineering comes in, right? And I'm not saying it's all bad. I mean, they want to uplift marriage, right?
Hmm.
And they want to kind of downplay when you're married filing separately. So that's the worst rate. But sometimes you can use married filing separately because you just get a better advantage.
Hmm.
Very rare, maybe 3% of the time, 2% of the time, married filing separately is actually better for a tax outcome for both people, right?
And what instance would that be?
Where one of them has let's say high income
Hmm.
and very high deductions, right? That would be an instance that would happen. That it would just work out that the married filing separately would be a better deal for them.
Okay. All right. I'm sorry. I didn't mean to cut you off. I
No,
just
no,
wanted to
no.
make sure I
Yeah,
asked that while it was fresh on my brain. But
yeah.
continue. You said there was another instance where you were able to
Another instance.
save.
So it was a home care client who
Hmm.
came in. And by the way, yeah, we work with home care clients. This is one of our niches. But yeah, I mean, home care client comes in, standard. Okay, give me your last 3 years tax returns. And what we do, we you know we take it, parse it out, put it on a spreadsheet, see where the numbers are, that kind of thing.
Hmm.
And I said, okay. I said, great. Well, thank you for all this. Can you send me your accounting for this particular year, right? So she sends me the accounting for this particular year. So I'm looking at the thing. I'm like, okay, great. Can you send me the bank statements? Take the bank statements. There was like about, I don't know, I want to say between PPP loan money
Hmm.
and some other private loan money. Whoever the accountant was who did it, they included that in income. And you're not an accountant, Shay, but even
Loan. You can't
yeah,
tax a loan. Yeah.
exactly. It's loan. You got to pay that back. It's loan money, right?
Yeah.
So I was able to, do an amendment for her, and she got about $98,000 back. I remember on the check for that
Man, I'm
one.
sure she
Yeah.
loved you.
Oh yeah, yeah. It was pretty cool. Um, I remember. So for her, I know that it was over $400,000. Well, not well. There was found money. We did a tax plan for her, right?
Hmm.
And on the tax plan, you get found money, which is you amend the tax return. That's money already spent, and then you do extrapolated savings, right? So you say, okay, let's just redo how you do your business in a way so that we can just restructure how you do things in
Hmm.
a way that saves you money, right?
Yeah.
So for her, she had her operations were in Philadelphia.
Hmm.
She lived outside of Philadelphia. I said, look, let's have a management company outside of Philadelphia. Philadelphia's got like a roughly about, I think it's 5 or 6% net income tax, right? In
Hmm.
Philadelphia. I said, certainly you have a home outside of Philadelphia and you have a home office there. And, it's a bona fide home office where you do your admin when you're away from the crowd and all that kind of stuff. And that you should be able to pay yourself in a management company there outside of Philadelphia. So you've got this, let's call it 6% Philadelphia tax. And if you're doing it that way on $100,000 of management fee, you're saving 6,000, right?
Hmm.
And if it's, and certainly you can reroute more. If it's paying 200,000, that's 12,000 that you save, right? So in strategies you you know, you stack up all these different strategies. The other thing with her is that she had um I think she had a Schedule C the year before. I think somebody tried to do the sub S for her, kind of botched it. So we correctly did the sub S election for her.
Hmm.
She got accepted for sub S election, and now all this money is going on her sub S tax return as opposed to a Schedule C, which saves a lot of money, right? Typically on a Schedule C, it's 15.3% because you're taking Social Security, Medicare, which is 7.65%, and and then you're matching it with the employer. That's what a sole proprietor does. You kind of match, so you get the 15.3%.
Okay.
And on 100,000, that's 15,000, right? So if you can move money off of Schedule C and move it onto a sub S, you can save a lot of money. Now with a sub S, you do have to pay yourself a reasonable compensation, right?
Hmm. And
Um,
is that based on the people in your same field, or is it just
yeah,
up to you?
yeah. Well,
Okay.
yeah. To your point, yes, it's based on people in your field, right?
Hmm.
There's a oh God, there's a name of a of an app that's called I think it's called, I want to say not Reach Reports. It's called something RCI Reports, right?
Hmm.
And you plug in a lot of data about the particular client. You put in the NACS code, which is the industry's codes and all that kind of stuff.
Yep.
You put how much they're making. You put their payroll in there, and you put in there what their duties are, and they'll kind of spit out what a reasonable compensation is. But old school was that whatever a sub S person took out in in dividends, they had to match it in payroll. So let's say you're netting before dividends or payroll, your own payroll, you're hitting 100,000, right?
Okay.
So old school was that you'd get a W-2 for 50, and then the K-1 is for the other 50.
Got it.
Okay.
Okay.
So but even in that, I think to the extent that your because it's because you wear two hats. When you're a sub S corporation, you wear a hat of owner, investor, and you wear a hat of worker or W-2 employee, right?
Yeah.
So you got two hats. So one hat as the investor, you're taking the risk. So you're an investor as then the other hat is you're the W-2 employee, right? If you're getting a lot of leverage from a lot of people, it seems to me that you could probably take more money out. And I don't know if this is I usually go to my son with this, right? I say, hey, am I saying this right, Gary?
Yeah.
He'll say yes, no, whatever. But but in as much as you have leverage, it seems to me you could take more money out as an investor because now you're putting money into a base of um, top labor working for you, and the more labor you have working for you, the more leveraging your money is doing, the more leveraging your money is doing, the less you're doing or have to do, right? And so you
Yeah.
can make more money that way. Yeah.
Got it. Okay. I'm going to tell you my investment strategy, and you tell me if I'm doing this right or not. The way I'm investing in real estate is I'm taking money from the rental income that I get, and then I'm putting that money into the stock market to build it up, and then my plan is to pull the money out and then buy more property. The I know that I'm going to
Yeah.
pay capital gains on the whatever I get from the stock market, but
Mhm.
will that offset what I buy in property and then whatever losses I take when I'm fixing the property up? In my head, it makes sense, but I don't know if that's the right thing or not. So that's why I'm
Well,
glad you're here to ask you that.
yeah. Well, I mean, but even before that, my thinking goes, well, you're actually you have an enterprise where you've got an asset where you're building, right?
Hmm.
And it seems to me that I mean, you sound like a unicorn to me because you're talking about having most real estate guys I know, they put no money in stock market. It's like
Yeah, I don't.
they
Yeah.
got yeah, they got money. Um, but yeah, I mean, you can if you know the stock market. Usually, if you're like Warren Buffett, right? Like he
Hmm.
just says, know what you're buying. If you know it, how it makes money, that kind of thing. You're very familiar with real estate. If that's
Hmm.
something you're very familiar with, I'd double down on the real estate, right?
Yeah.
Because presumably your real estate will probably give you your highest return, right?
Yep.
Tax or no tax, just economically, cash, right?
Hmm.
It'll give you highest return because you're probably been in real estate long enough to see cause and effect. Before you were in real estate, it was all theoretical, right? You
Yeah.
do it for a while, then you get in a relationship with the real estate. You get in a
Yeah.
relationship with rentals, people coming in. You start to get a flow of how this whole thing works.
Yeah.
And the higher your learning curve is for that, Shay, it seems to me that you would double down on that, right? But
Yeah.
I'm sorry, but repeat your question again about putting money in the stock market.
Yeah. So my plan is because what I used to do, I used to put the money that I was getting from the rents, I'll put it in the bank to buy more real estate cash.
Okay,
Right.
right,
That's the
right,
plan.
right.
But I figured since I'm seeing the stock market, as another vehicle to make more money
Sure, sure,
faster,
sure, sure.
instead of putting it in the bank, why don't I just put it in some
Oh,
companies
gotcha,
that I'm
gotcha.
familiar with?
I hear you. Yep.
And my thing is to pull the money out once it gets to a certain amount where I can go buy another property cash.
Hmm.
I'll pull the money out, buy another property. But my thing was from a tax perspective, does it make sense to do it the way I'm doing it? Because I know I'm going to pay capital gains, but then at the same time, I'm going to be taking a loss by putting the money in real estate and fixing it up and things of that nature. So would you think that was a good idea?
It could be generally, yeah, it could be a good idea. I mean, I don't know. I mean, don't forget about the real estate loss issue that I talked about earlier, right? If you're
Hmm.
going to double down and put and real estate's got it's got repair restrictions. I don't know if you've, I mean, since the new law years ago, that it gets very. It's not like back in the day you could just throw everything into repairs and call it a day.
Sure.
If you're significantly restructuring your your building, that's capitalizable, right?
Hmm.
Technically, it's capitalizable. You're replacing a wall, you're replacing all kinds of stuff. There's a very fine line between capitalizing, which means it goes onto the cost of the building, right?
Yeah.
Then you depreciate it. I mean, if you've got commercial or residential,
Just residential.
that's
Yeah.
27.5 years, right? So
Hmm.
27.5 years, that's roughly, I don't know, 2.5% a year, roughly. Is that right? Something like that. 2.5% or two point whatever percent of depreciation deduction per year, right?
Hmm.
Um, and so you could maybe get a loss, but it depends on how much. I mean, bottom line, if you get a loss, you can deduct it within that limitation I mentioned earlier about $25,000,
Yeah.
not going past that. If you're making over 150, you know those losses get trapped.
Yeah, because here's my thinking, and I know some people listening to this like, oh, this guy's an idiot because
Mhm.
the thinking is to get a loan, which is deductible, right? Instead of paying your hard earned money to buy the thing, but I know that there's also fees associated with getting a loan,
Yeah,
and
yeah,
and if
if you,
everything goes right, then yeah, you could pay the loan down and then pay it off. But if something goes wrong and you can't pay the loan back, then you're stuck with a loan, and the bank can potentially take the house from you.
they can take the house. Yeah, I mean, if it's collateralized, yeah, they can take the house.
Yeah,
I, I mean, it depends, right? So that's a different kind of question. I mean, certainly you can make money on the stock market, but not all the time.
sure,
That changes.
sure,
If you're good picking stocks, if you like index funds that don't, there's certain index funds are pretty good
yeah,
to go into. But if you like stocks, you're good at it, make money with it. Yeah, you could do that.
yeah,
Um, but you don't have to do that to take losses on your real estate. In other words, I mean, or I shouldn't say take losses, incur losses in your real estate. You don't have to do
yeah,
that. But like I said, you might be in an AGI or tax bracket where you're over the 150. Now you're married. Your wife she's got a W-2.
yeah,
Okay. Outside of real estate, you have a W-2. Is the podcast
yeah. I
your
do
only?
have. Yeah, I have a W
Okay.
two as well. Yeah,
Okay. So you guys
yep,
are making over that definitely.
yeah,
So yeah, that's going to be trapped for a while. To take that. And, I mean, I can certainly look at your tax returns if you're interested in having a second eyeball, looking at your tax situation. We can certainly do that.
sure. Nah,
Yeah.
I'll
Yeah.
100% take you up on
Hmm.
that.
Hmm.
I appreciate that.
Yeah.
One other thing, and I'll get off of that because I know we
Yeah. Yeah.
kind of
Yeah. No, no, no.
like it's this that was a selfish question. So to the listeners, I apologize, but hopefully somebody had that question as well. But I know you have your son working for you, right? And one of the things that I'm doing is I'm giving my son financial literacy information, right?
How old's your son?
He's 13. And with that, I'm giving him money to put into the stock market as well. If anybody what's the limitation of having somebody work for them, the age and where it makes sense to be able to write that off as well? Because I'm giving him money for the education. So I know he's not working for me, but is that something that I can write off?
Yeah, you can. I mean, if you well, okay, I'll put it this way. You have a bona fide business, right? Like a sole
Hmm.
proprietorship.
Yep.
You can hire your son under 18. So he's got to be, the tax court says older than or at least 7 years old,
Hmm.
up to 18, right? So
Okay.
okay, from 7 to 18, so 11 years. And you can pay them up to the standard deduction for a single person. I'm not really it's like about 12,000 or 13,000. I'm not really sure what it is this year. But if he worked for you under 18, you paid him 13,000, that money's non-taxable,
Mm.
right?
Okay.
So, but it's got to be a bona fide business, obviously, right? And then
Yep.
you keep time cards on him or timesheet on him. He has to have his own bank account,
Yeah, he does.
and then you could pay him in his own bank account, and then pay for things that you would otherwise pay for with after-tax money. Camp, lessons for this, whatever else, with really his
Wow.
money. And so you can tell, hey, so that's a way to, you're showing. And by the way, I respect that. I love that. By the way,
Thank you.
just showing your son, hey, this is how you do it. This is how freedom is one, right?
Yeah.
Learn a skill, and a 13-year-old, I mean, presumably he's probably very good with social media, right?
Mm-hmm.
So you can help you with that. Social media, you can help you with a bunch of stuff. I mean, the old days back, you help him vacuum your office, whatever, take out the trash, whatever, and but there's a lot of stuff you can do to
Mm,
have that. But yeah, you could take up to about 13,000, and even after the 13,000, it's at a lower tax bracket. It's at an effective maybe 5% tax bracket. If it's like 14, 15, whatever, it's certainly lower than yours and your wife's combined, right?
mm,
Yeah. So,
yeah.
but yeah, but you keep I would do a contract, like write a nice little cute contract with him, and then make sure he has his own account, timesheet, and then his job duties. Just have that, just for your records, and then just start paying that way. And there's no, the W-2s it's just W-2s. You have a W-2 at the end of the year. It's got no Medicare, Social Security, none of that stuff, right?
Mm,
None of that
yeah.
stuff. Yeah.
Okay. All right. This is good, man. I feel better because I did talk to a tax strategist, and they were telling me that I couldn't, but I figured I'd get a second opinion.
That you couldn't what?
That I could do what I asked you. They said I couldn't
Okay.
do. I
Oh, you could.
couldn't.
Yeah, you
I
can do it.
couldn't count that on my taxes or anything like that.
Yeah, it's got to be structured correctly, right?
Yeah.
It's got to be through a sole proprietorship, right?
Mm,
You can't just do it, willy nilly kind of
yeah.
thing. Yeah, sole proprietorship, and then you would have to actually go through and get a W-2 done, and the W-2 is made up of 941s. Those are quarterly reports that you do on a quarterly basis, right?
Mm,
And as long as you kind of cover the paperwork for that, as long as everything else is copacetic, you're good. You're good.
that's awesome.
I'm
It,
surprised. Yeah, you said that. You might. Yeah.
yeah. This was I was on an entrepreneurship call,
Okay.
and he was one of the featured guests.
Got it.
And then I got to ask him a question. I didn't have time for him to elaborate or me to for me to elaborate to him. I just told him, "Hey, this is what I got going
hmm
on. Can I do
hmm
this?" He said, "Nah, I don't think you can do that." So I'm
I'll
like,
send
"Oh,
you. I'll send you citation for that.
beautiful."
Because yeah,
Nah,
because doing this is one thing, right?
yeah.
Actually having authority to back up what you're saying, that's a totally different thing. And when it comes to the IRS, I mean, the IRS is fairly reasonable, but if
Mm,
you take a strong position somewhere, you got to have some backup. You got
yeah,
to have backup. You got to have, as they say, you got to have receipts, right?
for sure.
You got to have receipts. And
Yeah.
yeah,
One of the things I have a financial advisor, and one of the things I love about working with my financial advisor is that she didn't just tell me where to put my money.
right,
She educated me on why it was good to pick this or that or this or that or whatever.
right, right, right,
And it sounds like talking to you that you're the type of person who educates people and not just, hey, give me your stuff and I'm just going to put it here and I'm
sure,
going to
sure,
work my magic,
yeah,
but
yeah.
I'm also going to explain why it's a good idea to do X, Y, and Z.
Oh yeah,
Is that
yeah,
yeah.
absolutely. Yeah, we like, for example, when we do tax plans, this is probably the biggest one, right? We'll do
Hmm.
a strategic tax plan for somebody. As a matter of fact, new, I think I mentioned to you, we do monthly accounting, we back office, that kind of thing. And typically, when a prospect comes in, they want that. We'll typically say we got to do a tax plan. That's just standard, right?
Yeah.
You know, so we do a tax plan, and with the tax plan, we're showing these are the tax rates. Here's the history of the tax laws, and so forth and so on. Kind of gets into it,
Hmm.
and and we show that marginal tax rates kick in at a particular dollar amount, right?
Hmm.
But the layers before that are lower tax rates. So this up to this amount is, this percentage, this amount, this part is that percentage, and so forth and so on, right? So when you get to 37%, it's not like all of it is 37%. It's just that layer. When you pass a certain dollar amount,
Yeah.
500,000, whatever, everything above that's 37%, right? So effectively, the effective tax rate's different than the marginal tax rate. Yeah. So yeah, to your point, yeah, when like we're in this space all the time, right? And
Yeah.
it always kind of tickles me if somebody doesn't know something. But to your point, Che, yeah, they're doing like you're doing real estate. You know real estate at the back of your hand because you do it all the
Yeah.
time, right?
Yeah.
But when it comes to taxes, and I think frankly, I think taxes, it's almost like meant to be that way. It's meant to be a little confusing, right?
Yeah.
Because it's like really
Yeah.
I remember, God, years ago when the old tax law came into 1986. This is a long time. I was at Tasty Baking Company, and you
Mm.
look at I mean, the code's like this big, right? You look in the, and you see certain code sections, and it'll say, this rate is so and so, except for a corporation in Alaska with, $100 million, and it's a senator giving one of his constituents, a way out for that particular code section.
Uh,
So the code section gets really, really weird, right?
yeah.
I'm thinking, I'm guessing, certainly with the new administration, they might want to pare it down. I don't think they're going to get rid of it. I know he's been, talking about getting rid of it. I doubt that they're going to get rid of it.
Yeah.
You're always going to have taxes, obviously, but he might pare it down somewhat, and
Yeah.
we'll see how that happens.
And I think just full transparency, like I give my tax guy all the information he needs and I say,
Hmm.
"Hey man, do what you need to do.
Yeah,
Like just
exactly.
don't get me locked up."
That's right. That's right. That's the number one. Keep me out of jail. Keep me out of
Please.
jail. Yeah, yeah, yeah.
Yeah, yeah. But yeah, I think just having the a little bit of knowledge can go a long way. And I feel like, from just having this conversation with you, it sounds like you try to educate people so they can make informed decisions. And that's the best way to make a decision is have all the information to make it.
It is. Yeah. Yeah,
Yeah.
absolutely. Yeah.
So somebody works with you, say get in contact with you, say, hey, I want you to do my taxes. You do the taxes, and then do you make recommendations on how they need to do things moving forward so they can,
Yeah,
keep as
that's a
much
good
money as
question.
possible?
Yeah, that's a good question. Yeah, so like somebody called in today. Like I just had somebody today call in, and typically we'll get a phone call. They'll come in. They might go to my website. They'll put in, I'll get a Calendly thing pop up on my email. Go to Calendly, and I'll call them up and I'll, kind of go through it. And I said, so why are you here? Why? How can I help you? Not like that, but
Yeah, no, I
how,
understand.
how,
Yeah.
how can I help you? Hey, how you doing? How can I help you? Um, and then they'll explain to me, like this one today explained to me her father did it and he stopped doing it, and her tax return's kind of complex or whatever. I said, okay, I'll tell you what. I said, I will send you a recap of this phone call and I'll set you up on Tax Dome. We have a platform called Tax Dome, is where your portals, you know about portals, you send upload
Hmm.
stuff and all, yeah. So I said, I'll set up a portal on Tax Dome for you and I'll send you a recap of what we talked about. Right.
Hmm.
So I'll put a recap like, hey, Jane Doe called and we went over all these different things. She's got, 3 kids and real estate and blah, 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 exotic stock sale. And she sold a limited partnership interest and she blah, blah, blah. And I'll put next steps, upload your last year's taxes. Usually for that, she's individual. So business, I'll say 3 years, individual,
Hmm.
just last year's. And I just, for her, I said, just give me a narrative about what you're looking for, what your issues are. And so I send that out to her and she'll upload her information. Then I'll take a look at it and see what's going on. So to answer your question, I'm sorry, I'm kind of going wrong. But to answer your question, I'll look at their particular, we'll get to a place where we have a draft, right?
Hmm.
So we're looking at the tax return, comparing it to the previous year. Are there any significant deltas between the previous year and this year? you
Hmm.
know and if not, we'll have a draft, right? We'll review it and then we'll talk to the client about it. It says, hey, here's a draft. You've got a few minutes to kind of go through it. And yeah, we have. I mean, I had a client, new client, what, last year came in, um, and they were taking a loss with a pretty sizable W-2. And I
Okay.
told I told him, I said, you don't have to take, you're an S corporation. You really don't have to take a sizable W-2 when you have a loss, because now you're paying, all this Medicare and Social Security tax. And the guy was like, I'm 65 in a couple of weeks, right? So he's like, I said, you don't have to do all that. Why, you're trying to save some money here.
Yeah.
So just with that adjustment that he made, he saved about $13,000, right? So it's very easy. Like same thing with you, right? You go
Yeah.
into a building, a house. Your wife says, "Honey, we got to, got to get some more houses here."
Yeah,
She
you
yeah.
sound like you've been in my house somewhere because
Well,
she's
yeah. He was I said about 13,000 because he was paying himself just too much. He
Mhm.
had a loss. I said, you should just take the 50, take the loss, combine it, take half of it, and pay the W-2.
Okay.
Right,
Yep.
just half of it. Now that's reasonable considering how much you made that year. And so for that year, he didn't, obviously he already done the W-2, but come into 24, he adjusted his W-2 to make it a much lower amount given his activity.
Wow.
Yeah.
So then so for everybody else, excuse me, for everybody else, then you'll not and him as well, obviously, you'll
Yeah.
put
Yeah.
together a plan moving forward on how to move so they
Yeah.
can save
Yeah.
themselves money.
Yeah. Because I have to do that. I mean, in a sense, I'm a professional, right? So it's like, well, not as well, what I meant to say, I am a professional,
Yeah.
but in a sense, I have to go in and give feedback to what I see. I can't just, as a professional, I can't just look at the tax return, right, and just go okay, and just like be a robot and do the current year and keep moving.
Yeah.
If I see something on the tax return, I got to let them know. As a professional, I have to let the client know, hey, I've noticed this thing here. Did you ever think about doing something different? Did you ever think
Yeah.
about why are you doing this? So we'll dig in. We'll dig
Yeah.
into the tax return. Yeah, we'll dig into the tax return. We'll dig into their motivations for doing things.
Hmm.
I mean, you had mentioned, putting money in the stock market. I
Yeah.
said, well, what kind of returns are you getting on your real estate, right? I
Yeah.
mean, compare, like, I guess, I don't know if it's called internal rate of return but compare your returns on real estate versus the stock market. Stock market is like,
Yeah.
it can be kind of a casino-ish environment. Your real estate, you're familiar with it.
Yeah.
The brick and mortar, you've got a relationship with that. So
Correct.
within a relevant range with your real estate, you know exactly what to do to make it go up, down, whatever, right? Get more rentals, increase the rentals, right?
Correct.
All that stuff. Yeah. So like for us, Vance and Associates is my biggest return that I can put my money into. So I'll put my
Mm.
money back into Vance. I got SEPs and so forth like that,
Yeah.
Metroplan, but Vance and Associates right now is the best place for me to put money in to get a return on that money. Because I know exactly, we've got, on a financial statement, as you know, you've got top line revenue, right?
Yep.
You've got a section called the cost of goods sold section or the cost of services sold section, right? And those are so-called direct costs, right? So these numbers in the direct costs are what leverage the revenues on top. And
Yep.
then down here is like general administrative expenses. They're so-called fixed expenses. They don't really change depending on your revenues, like your lights or insurance, stuff like that, rent, mortgage interest, whatever, right?
Man.
Yeah.
Man, this has been amazing, man. I know we're pressed for time, man. I would love
Yeah.
to ask you a lot more questions, but I feel like
Next time.
we need to have you back. We need to have you back on here.
And Carrie, let Carrie come back too. Yeah.
Yeah, no, for sure. Yeah, we can definitely set that up. This has been amazing, man.
Well, thank you, Che.
And I
Thanks.
and I
Thank you.
appreciate the all the information that you gave me, and then hopefully you gave our listeners and watchers something to think about, and then hopefully work with you. So speaking of that, how can people find you, work with you, social media, or you on
Sure.
LinkedIn, all those things, and we'll
Yeah.
put it in the description. But go ahead and
Yeah.
talk about that.
Yeah. So it's Dean Vance CPA. So website www.deanvancecpa.com.
Hmm.
And I've got all these other, I mean,
Yeah.
LinkedIn. You could just look it up and see Dean.
Yeah,
Dean Vance CPA.
we'll put it in the
Put it together.
description
Yeah.
for
Yeah.
you. But I
Yeah.
just wanted to make sure I had an opportunity for you to give your website so then
No,
people
thank
can
you. Thank you, Che.
dig a little bit deeper in and then
Yep.
hopefully hire you to be their
Yeah.
CPA.
Absolutely, Che. I mean, we're in an interesting time now, and really, I mean, if you know, in a sense, being outside the box, because I mentioned to you, I'm a high DI, right? Disc
Hmm.
assessment, right?
Yep.
I'm not a typical CPA. CPAs are very anal, right? Very,
Buy
I'm
the
not.
book, like
Yeah,
that,
exactly.
like robots.
Like robots, like stay within the lines.
Yeah, yep.
Think of all the billionaires you can think off the top of your head. Elon,
Mm-hmm.
Bezos. These guys within the line? No, they're all
Yeah.
outside the lines.
Mm-hmm.
Probably all of them are or more than half of them dropped out of college.
Yeah.
You know, it's like
Yeah.
it's like you know, it, and that's where creativity is.
Yeah.
Creativity is outside the lines. It's like the R&D department, right? Of course, every now and then the lab in the R&D department blows up, right? So
Yeah.
you got to have it away from populations, right? But I
Yeah.
mean, but that's where
Yeah.
all that stuff happens. Yeah.
Nah, this has been awesome, man. And I'll definitely be reaching out to you to get another set of eyes on my stuff so we can see if there are some areas of opportunity for us to do better.
Absolutely, Che. Hey,
Yeah.
be a
So
pleasure for us to do that. Love to. By the way, I really appreciate you. You got a great sense about you. You're serious, but you're
good
chill
time.
too. Yeah,
Yeah.
exactly, exactly. You're the like when all the families in high school when they were partying, right?
Yeah.
They all the mothers say, make sure Che drives.
Yeah,
Okay,
for sure. My friends are like that too.
make sure
I'm
he's
always a designated driver,
That's
man.
right. That's right. Make sure he drives. Nice guy, but he's responsible too. He's not
Yeah,
just
nah, I appreciate you, man. Thank you so
yeah.
much, Dean. Guys, hopefully, if you have gotten some nuggets, some jewels from all the wisdom that Dean Vance had brought to this podcast. Wealth is a journey. We will see you next week. Peace.